Let's talk today about your home equity.
This is Kasama Lee, your community realtor.
One of the things I love about real estate is the tremendous amount of gain in equity that could literally retire people. You know, it's good to have diversified investments, right? It's good to have some of your money in stocks, in bonds, in CDs, and I could go on and on about the different investment vehicles. I just am a firm believer, not just because I'm a real estate agent. Well, I guess a big part is because I'm a real estate agent. I'm a firm believer that your money can grow, your investment can grow in ways that you can't do on your own when you leave it in real estate. So today we're going to talk about equity. We're going to talk about what it means, and we're going to talk about where most homeowners are statistically, nationally, and we're going to talk about what you can do with the equity that is in your home. So let's just start with this. What is an equity, right? Equity is the difference between the value, the current value of your home, the market value of your home, and what you owe. You know, when you bought your home and you went and got financing, and you're not the only one who owns your home. If you are making mortgage payments, the bank actually has a part of owning your home. So until that mortgage is completely paid off, what the market value of your home is minus what you owe to the bank or the lender, that's your equity. It's the part that you own. So when you sell the house or when you refinance and you decide to pull that equity part money out, that is your equity. That is the gain that you have earned over the years by having bought your home. I know of many clients, and it just really, their stories touch my heart. I know of this one couple that, you know, they came to the United States with hardly any money in their pocket, and they talked about being in the refugee camps. So you can imagine they came with clothes on their backs. And years later, they saved up, they worked really hard, and they saved up money, and they bought one property. And then they pull money out of that property and they bought a second property, and they did the same thing several times, and they ended up owning several properties. And so there's the primary home that they live in, right? And the rest of those properties that they have, the multiple properties they have, they rent it out. So they became landlords. And years later, I had the opportunity to be introduced to them, have been able to serve them as their family realtor, and sold several of those investment properties for them. And now they're retired. They're able to retire because of the equity that they had earned over the years of each one of those properties. Even though they worked until, up until their retirement age, it's really the equity of those homes, once they were liquidating them, they were selling them, that allow them to be able to completely retire from working. So equity is a powerful, powerful, powerful retirement tool. And I would just leave that with you. And if this information, this kind of video is valuable to you, you want to hit subscribe and the bell notification so you don't miss future videos. And I want to thank you from the bottom of my heart for sharing the video of contents like this. We want to get as much of this educational information out to the consumers, and for liking and subscribing. Appreciate you. So continuing on about equity. According to the recent studies by the Census and Attom, Attom, it's a award-winning housing report publication. Okay, you can look them up. But according to those two entities, currently nationwide, 2/3 of homeowners either own their homes completely paid off in full or over 50% have been paid off. That's huge. This is also one of the very strong reasons. So if you're wondering if the market is crashing, are we going to head into what we had in 2009, 2010? What we have now that we didn't have back then is that we have more people. I just told you 2/3, right, of homeowners who either own their homes outright or over 50% of their mortgage has been paid off. So they own over 50% of their equity. So those people are not going under. They're not running away from their homes. They're not letting it go to foreclosure. That's why the market is going to hold strong. Even though it's been challenging because of the interest rates, the Fed is doing a good job, by the way. You're starting to see interest rates reduction. And because, it has been going on like this for over a year now with the higher mortgage rates, and it's starting to come down. Well, guess what? I know that we're working with buyers who have just sort of sat on the fence, and they're starting to look again, and homes are going into escrow provided that it's priced competitively and there are no deficiencies with the property itself. They're moving, they're getting into escrow. We're still seeing multiple offers on some of these homes. So it's not as bad as you think. So if you're not out there house hunting, or if you're not selling a home, you may think that the market is just going into some sort of depression. It's really not. Okay. So with that, we just talked about over 50% of homeowners, right, are in great position. 39.3% own their homes free and clear. No banks. Remember, I told you the mortgage companies, they don't even have to make mortgage payments anymore. They're just paying for property taxes and insurance and utilities, basically mortgage free. Oh my gosh, can you imagine that? And it's the clients that I was telling you about, the family that I told you about, that basically they own those properties outright free and clear. So when they sold, let's say they sold a property for $600,000, they're just paying for the selling expenses, the commission, the prorated property tax, the escrow and title fees, and everything else went back into their pocket. Hello. So there's a lot of that's going on right now. I can tell you that many of our clients that we have served in the last, 24 months, many of those properties, they own free and clear. There is no outstanding mortgage on it. So it's true. It's happening. So 39.3% are homeowners who own the property free and clear, no mortgage. 30.8% of those homeowners have 50% or more in equity of their home. So that is encouraging. That is great news for our economy. What you have heard about, what investing into real estate is really long-term, a sure way of really building and developing your retirement portfolio. So if you can do it, if you are starting out, you may be, expecting your first child, or if you have a couple of younger kids, and you think it's hard, but you're living somewhere, and if you're paying rent, that rent's going to go up, right? So if there's a way for you to be able to just hunker down, ouch, it hurts a little bit when you're buying a home. It's not supposed to be comfortable, but if you can do it and get the down payment, whatever that looks like together, you want to get your hands on home ownership, okay? Now, I'm going to talk a little bit about different loan programs. I'm not by any stretch of imagination a lender, but I have worked with many, many, many lenders where I have familiarity of different loan types. I'm just going to kind of gloss over them, but if you think that you need 20% down to buy a home, how many of you? Raise your hands. No, you don't have, just nod. I can't see you anyway. But if you think that you need to save up to have 20% down payment to buy a home, that's not the case, okay? You can literally start the mortgage pre-qualification if you have 3.5% down. So for example, if I'm just gonna make it easy for the math, simple math in my head, if the price of the home is $200,000, 3.5% of that is what? Well, 7,000. Is that right? Yeah, 7,000. Because 100,000, 3.5% is 3,500, right? So check my math. It sounds right to me in my head. So if it's $200,000 home, you need to have $7,000 down payment to get started and get a loan called FHA. It's a government-backed loan. A lot of first-time buyers, as we see offers come in, that's typically the type of loans that we see. Plus, if you're a first-time buyer, there are a lot of first-time buyers financing assistance programs out there, depending on which county you're in and so on and so forth, okay? So what you want to do first is get with a highly competent lender who is familiar and has worked with first-time buyers, because the programs are very different. And I know some lenders don't work with first-time buyers because they don't put the two pieces together. You come in with a straight down payment and they see if you have a closing cost to go with that, and they don't deal with the first-time buyers assistance programs that are out there. So you need to interview the lender and make sure that they are familiar and they specialize in first-time buyers programs, because there are a lot of really great programs out there. Just worked with a client who was able to get a grant, a $50,000 grant towards their purchase. Now, if you want more information on that, you can just reach out to me at kasama@kasamasells.com. I can get you connected. It's not guaranteed. It's like, that saying, while supplies last. So as long as they have the funds in the pot of funds that are available in the grant, then you would be able to get that. And sometimes it's not a grant, it's a loan that you don't make payments on. We call it a silent second. So if you can get that, you don't even see that payment on your mortgage payment schedule at all. You pay that second silent. That's why it's called second silent. It stays silent, right? Until the end, until you either refinance out of that loan package or you're selling your home. Then that silent second would get paid off. Usually there's some added interest that you have to pay, or there's some equity share piece that you have to pay. But you know what? If that gets you into a home and you couldn't do it without that silent second, why not? I remember distinctly a family who were able to qualify for that silent second type of program. So in Napa County, there's a thing called proximity program, and that's the program I'm referring to. So every county, usually there is something that you could use. Sometimes it's a CalHFA, which is a government-backed loan. That's a first-time home buyers assistance program as well. So you can look into that. But that helps towards your closing costs, because there's a closing cost to it's not just the amount of money you borrow. You have to be able to bring funds to close in addition to your down payment. So you want to talk to a reliable lender to really understand those pieces. And usually I will get you connected to one or two lenders that we trust, that we have worked with, to really break it down for you, okay? So if you want more information on that, email me and I will be happy to get you connected. Now, the last piece I want to leave with you is, so then what happens if you become one of those people that have over 50% equity? Oh my gosh, right? Isn't that amazing? I mean, that's the whole journey of home ownership and the rewards of home ownership when you have owned and have made your payments faithfully over the years. What do you do with that equity? That's so much money, right? Or what if you own your home free and clear? You don't even have a mortgage anymore. What do you do with that money? Well, first of all, you should take a trip with your family, go on a lovely vacation or two, right? Well, you don't have to take my word for it. You do whatever you want. It's your money, right? But that's what I would do, right? And then the other thing that you could do with that equity is you could either get into a refinancing where you can take that equity. You in order for you to pull that money out, you have to get a financing. So you got to get a loan, right? So let's say you own the property and you have the property and the value is $600,000 and you don't owe any mortgage. So your equity is $600,000, right? And let's say you want to buy an investment property, just like what I told you, the earlier example of our client. So let's say you do that and you want to pull out $300,000, right, towards down payment of the purchase. Or maybe you're buying something out of state where homes are literally selling for $300,000 and you want to pay for an investment property all cash. You go in, you basically get a loan out of that primary home that is worth $600,000, pull $300,000 out, and you use that money to purchase a second property. Yes, now you're going to have payments you have to make on the $300,000 that you pull out. But you know what? A wise person, a financial expert, said this, and it's always stayed with me. Your money doesn't do anything if it's just sitting there. It doesn't grow on its own. It's not like you can water it and give it sunlight like plants and it's gonna grow, right? So if it's just sitting still in a box under your mattress or in a bank and it's earning 2% when inflation is above 2%, you're losing money actually, because there is no gain when the inflation, what the money is worth now is $1 is worth less than what it used to be worth 10 years ago. And if you're not growing it, you're actually losing money. Money isn't everything, but if you're not growing it, how are you going to retire, right? So if you can find a way to reinvest the money so that it would grow, and if that means you put it back into real estate, that's what we do. That's one of the vehicles that our family have made a strategic decision to do. Why not, right? And you work on getting great tenant into the home. They will basically be paying for your mortgage. Sounds good, right? So I wanted to leave some of those ideas and thoughts with you about home equity. I wouldn't speak about something that I am not practicing. And I know that real estate can be one of the really great, most reliable, long-term investment vehicles that will lead to your retirement. And it could even be your kids' college funds if push comes to shove. You might want to look into the 529 college funds program for that, but that would be another vehicle for you to be able to contribute to your kids' college funds. They don't get really expensive until they go to college. That's when you really feel it. Both my kids are in college. Anyway, I hope that you got some value out of this video. Let me know if this is helpful. I would love to see it in the comment or reply back to me. And what other areas that you may be interested in. I'd love to be able to just touch on that, and I'll bring in some experts and we'll do like an interview format to share that with you as well. Thanks for watching.